Happy New Year, everyone, and welcome to Mint Funds Update. My name is Marek Krzeczkowski, and I'm joined by Ryan Falls. Today, we will talk about market outlook and what happened within our funds in December. Our 2025 outlook hasn't changed. We still believe that global recession is unlikely. We see 25 as a continuation of so-called soft landing, where inflation returns to the range and central banks can respond to any slowdown in growth. Now here we are showing you a GDP forecast from OECD. They align with our expectations. At this point, we think that this will be a recovery year for New Zealand. And as you can see here, expected growth is real growth is around 2%. And we think there will be a continuation of strong growth in the US. Now, currently, we have been going through a bit of a shakeout in the equity markets. The last 2 weeks, we saw a spike in bond yields, and as a result, a bit of a correction. However, we believe that this is a normal phase during bull markets. Here on the left-hand side, we are showing a chart which basically compares spikes in 10-year bond yields to equity markets. And every time that we have those spikes, we see a bit of a correction. We believe we are going through that phase at the moment, but overall remain constructive and positive on equity markets going into 2025. Now, on the right-hand side, we are showing you the PE valuation chart of the US growth stocks. And the question is, are we in the bubble? And you never know if you're in the bubble until you leave the bubble. But what we think is really interesting is if you actually look at the absolute levels of PE, they look quite high. However, if we adjust them for the current bond yields, actually valuations are not that stretched. The question is what would actually push equities price forward and up from here. Now, the big story of 2024 was just introduction of AI and some ideas around it. Here on this chart, we are showing you the productivity growth before COVID and after COVID. And what you will see is that in the US, we have seen over the last 4 years a remarkable productivity growth. So in the US, we had a 1.6% per annum. We believe in 2025 we'll see a wider adoption of AI, and as a result, this should be beneficial and support earnings of the companies that we invest in.
Okay, if we turn now to New Zealand, we have a chart here on the left-hand side showing the recent Q3 GDP print that came out in December. And on the right-hand side, we have a chart showing the core Crown tax revenue as released as part of the half-year economic financial update. And I guess what we're trying to show here is that we had two negative, prints, data prints in December. So we had the weak GDP print, which was down 1% quarter on quarter and down 1.5% on an annual basis. And then we had a fairly weak half-year economic and financial update from the New Zealand Treasury. What this means is what we see this as investors have now priced in a negative picture of the domestic economy, and it's effectively at its lowest point. Going forward, and alluding to what Marek said, we have a more positive view and constructive view on the domestic economy going forward. Turning now to the fund performance for December, we'll start off with Diversified Income Fund. So asset class performance was mixed in December, with some of the steam running out of global equities in the face of reduced US rate cuts in 2025. So the fund was up plus 0.2%, with fixed income contributing plus 1% as the highest contributor for the month. Global equities was down negative 0.7%, and Australasian equities was down negative 0.1%, both detracting from performance. Turning to the positive side of the contributors, we had fixed income. So as I mentioned, up 1%. There was some domestic outperformance in the New Zealand rate market relative to global comparators. With the Q3 GDP print and the half-year economic financial update from the New Zealand Treasury disappointing in December, it led to a rally in short-end interest rates, with the government curve also steepening 23 basis points. So the fund actually benefited from being overweight shorter duration bonds. Turning to global equities, we had Amazon up 5.5% and LVMH up 7.3%. and they were the top 2 contributors for December. Amazon outperformed after analysts upgraded it to buy during December, and they cited some upgraded potential for AI-related revenues with its strong market share in cloud computing. In Australasian equities, Somerset Group Holdings was up 2.2% and Serco was up 3.5%, and they were the 2 standout names. Somerset actually appreciated on a stabilizing NZ property market, and then also a well-received investor day during the month of December. Turning to the negative contributors within global equities, we had Cigna Group down 18.3% and Novo Nordisk down 17.6%, and they were 2 detractors from performance. Cigna Group slid after management announced that they were not pursuing a combination with Humana, and also slightly weaker earnings guidance. Within domestic equities, Megaport was down 6.6% and Charter Hall Group was down 8.7%, and they were the 2 main detractors. Megaport dropped on a wider sell-off in the Australian tech sector for the month. So now turning to the Diversified Growth Fund, the fund was down negative 1.9%. Again, asset class performance was mixed in December. So we had fixed income up plus 0.2%, and that was the largest contributor to performance. Global equities was down negative 2%, and Australasian equities was down negative 0.1%. Turning to the positive contributors within global equities, we had Broadcom Incorporated up 43% and LVMH up 7.3%, and they were the top 2 contributors for December. Broadcom exploded in December after the chip maker released news that its AI-related revenue jumped 220% in the 2024 fiscal year, and then they also projected further growth in that area for the business. In Australasian equities, Serco was up 3.5% and Proto Turunga was up 4.7%, and they were the top 2 performers for the month. Serco bounced on news that they were rolling out a new data content offering with Amadeus, expanding its multi-source airline retailing capabilities. Again, within fixed income, we've seen that domestic outperformance relative to global rates, and the Diversified Growth Fund also benefited from being overweight shorter duration bonds. Turning now to the negative contributors within global equities, again, we had Cigna Group down 18.3% and Novo Nordisk down 17.6%. Novo Nordisk actually fell on news that its latest experimental weight loss drug, CagriSema, had disappointing results within its phase 3 clinical trials, and that was against market expectations. Within domestic equities, again, we had Megaport down 6.6% and Charter Hall Group down 8.7%. Charter Hall Group dropped amid a wider Australian real estate sell-off, and then also the market reacting negatively to rumours they were eyeing up a bid for the retirement village operator Avio Group.
Thank you for listening. If you have any questions, please send them to info@mintasset.co.nz.